Hello, my name is Mark Berry, and I'm the owner of Dependable Mortgage Solutions Corp, or DMS for short, and I'm your host of Learn to Lend. This is a podcast for inquisitive minds looking to learn more about residential private lending in Alberta, or just wanting to find out more about who DMS is, what we do, and how we do it. So with that, let's get into it. Hello, and welcome to today's podcast. Today's episode, I want to touch on what makes a DMS deal, kind of what things we look for, what aspects of the file, what adjudication and underwriting has already been done on your behalf. So with that in mind, what we want to do at DMS is we want to present to you the best and most accurate information that we can provide. So we're going to get lots of applications in. Many of them are not going to make it to you. In fact, the vast majority will be discarded and thrown away. So one of the very first things we look for is what's called LTV, or loan to value. And so right now we have a cap at what's called 80% loan to value. So the combined mortgages cannot be more than 80% of the value of the property. And that's key because that gives us the security. One thing I've always said in this business is the property protects your principal and the borrower earns your interest. So when we look at protecting that money and creating the security, we look at that loan to value. And so right now the current cap is 80%, and we can do that through a combination. Typically it's a first and a second would go up to 80%. So one of the ways that we confirm that value is on every single deal, we get an appraisal. Okay. This is not a realtor CMA, which has some value, or what's called a competitive market analysis. It's an opinion of value. We go out and get a paid for licensed appraiser to go out there and basically certify their opinion of the value based on the comparables. And on another episode, I'll touch in on appraisals and what we look for and how to read an appraisal and all of the things that go into an appraisal and maybe some of the pitfalls that you should avoid. So once we have the appraisal and once we have that value, we want to confirm the details of the file. So anything that's been submitted, we want to make sure that that is accurate and it accurately reflects the applications being sent in, whether it be the borrower's identification. We'll go through and do several checks on what's called PEP, or politically exposed persons, and anti-money laundering, and any of those other new regulatory aspects that came in October of last year. We want to be sure that we're on side with all of the new government regulations in regards to those. So we look at that. We look at verifying that the borrower is employed or has some sort of means of income. And then we look at their credit. And so credit, we get a credit report. We have a look through that credit report. And when you see the deal on the portal, you'll see various levels of the credit. If you want to have a look at the credit report, just go ahead and ask. It's fairly detailed and there's a lot of information, sometimes hard to read. So that summary that you get from DMS really will show you a good snapshot of the borrower, whether it be poor credit, below average, average, above average, or excellent credit, or not applicable. And sometimes when you have a new to Canada, you might not have an applicable credit, or you've had somebody who's never used credit. Sometimes farmers are notorious for not even using credit. And so that's why you could end up with having not a credit score. That being said, after that, then we want to look at affordability. So when we look at affordability, we want to be sure that the borrower has the capacity to pay us back. Back when I worked for the bank, we looked at this kind of declared income, what was filed with CRA, your T4s, your last 2 years. In the private space, I move away from that a little bit. And what I'm really looking for is a snapshot of where the borrower is right now, or where they could be in the next month or two after this loan is paid off. So sometimes they've just started a business, they have no declared income, but I know they will, or they just finished school, they just graduated, and on paper, they don't have a well-paying job, but I know as an engineer, they're going to get paid really well. And it's just a matter of timing. Okay. Or they move from another province and they don't have employment, but they were a nurse in Ontario. So pretty good chance they're going to be fine here. Okay. So those are the things to look for from an affordability aspect. It was called the ability to repay the loan. Next, the one we want to look for is what's called the reason for the funds. So this is really key. It goes to the overriding aspect that we'll get into the end, is that there has to be a particular reason for the funds. And if there isn't a reason, that usually means they don't want to tell you the reason, because there's always a reason to do this funds. And so understanding the reason and the rationale for why they need these funds is key to the security and the repayment of this loan. So you'll see that in the loan notes as well, in the summaries that we provide to you. We've already gone ahead and looked to try and get that reason for the funds. After that, we want to have a good look at their bank statements. We want to see kind of a snapshot of where their bank statements are right now. A lot of NSFs, if there's some, discrepancies in the banking information, or, if they're trying to hide information from us. It doesn't automatically mean a decline if they're trying to hide it, but it certainly raises some red flags. And that's certainly something we'll spend extra time to assure that the information is correct when we get to you. Okay. After that, then we want to have a quick look at the kind of property location. So we'll have a look at that location, and that location will then tie back into that original thing, which is that LTV, or the loan to value. So our loan to value, when I say it's 80%, that's 80% on the max scale. Great property, strong borrower, deal really makes sense, really strong deal. And then we scale it back. Don't have all of those checks in line. So if the property's a little bit more rural, if the property is not in prime condition, if the property is unique, if the property has incomplete details, maybe it's under renovations, so then we'll scale the loan to value back. And in my experience here in Alberta, is rural properties are not as scary as my friends in Vancouver want to think. Is that I have always found that the rural properties perform very well. The reason we scale back the loan to value on rural properties is primarily due to a length of time it takes to sell that property, whether it be sold by the borrower, whether it be sold by the lender or us through a foreclosure proceedings, for whatever it is rural properties do not have that quick turnaround on sales. So we can be left holding the mortgage in first or second position, and all of those charges and interest can be accruing, and therefore we want a little bit more space or wiggle room to ensure that, there aren't any losses and the loan is then funded and performs as it should. The last thing we want to look for is exit strategy. So we look for exit strategy and go, okay, how long are we going to be in this deal? And is there a path to transition this deal to either a lower cost lender or a longer term solution lender? And so that's key. Sometimes the exit strategy is literally just a sale. Sometimes the exit strategy is liquidating the property. Sometimes the exit strategy is transitioning to other financing. So we want to have a look at that and see if that's actually realistic or not. And that's one of the things we'll do prior to the deal getting to you. These are all things we want to look at before we even present any deals to our partner lenders. The last one I always go, and I always say this is the most important, and that is, does the deal make sense? And that is probably the one thing that my time at CIBC and my time in lending was not important. Okay. We didn't really touch on, does the deal make sense? It was always, does it fit into that box that we talked about early in other episodes? Is as long as the ratios are in line and as long as everything lines up, the deal is okay. In the private sector, because we're on the edges of these and our box isn't isn't a team. It's a flexible box. It works with the deal. It works with the project. It works with many other things. And so I want to go, does this deal make sense? But why is this borrower doing this deal? Will they be better off? Will they be worse off? I often say are we throwing them a lifeline or are we throwing them an anchor? And if we're throwing them an anchor, maybe this is a deal we pass on, because throwing them an anchor typically means we're just going into the foreclosure business and we're into the legal side of private lending. And all we're doing is just feeding our lawyer documents and feeding the court documents. And there's enough files out there that we can make money without having to go down that path. So when we look at deals, that's what we look for. That's what I want to see. And that's before the deal comes to you. Those are the things we want to cover. And you'll see on our little videos, when we do these property summary videos and these little walkthroughs, we'll be covering those points off with you so you can have a better understanding of why we believe the file is a good deal and why we believe that this is a fundable deal and we should be doing it. So if you have any questions, by any means, reach out. We're always here for you. We're here to answer questions, and we love to talk mortgages. We love to talk private lending, and we want to see you and everyone else succeed. So thank you. Have a great day and wish you all the best.